Welcome to the Southeast Retirement Planners podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoy this week's episode.
Hello, everyone. I'm Les Stuart, and this is the SRP podcast. And today we're going to do something a little different. We have a guest speaker, a close partner of ours, Michael Cole, who works with Clark Capital. He is a senior investment consultant there, and he's going to be sharing some information on the current state of the economy and a little bit of the outlook that Clark Capital Management Group has. But first, I'd like to talk to you a little bit about our podcast. We do this on a regular basis. It's a chance for you to hopefully get some education about the markets and investing and just some life tips. And then also it's a way for you to get to know us at Southeast Retirement Planners. And also you can go to our website, which is seretirementplanners.com, and learn even more about us and our group and how we interact with people. So with that, we'll go ahead and get started. I've already introduced Michael, and Michael, you guys have just put out your quarterly economic update and outlook, and so we're going to walk through that. I know in the you guys do a set of gauges, which is a way to kind of easily understand how the economy, where the economy's at, and where you guys think it's going to go, and make it easy for some of us that aren't just immersed in the financial jibber jab all the time. So if with that, I'll let you get started and kind of explain that a little further for us, I guess.
Yeah, thanks, Les. I appreciate you having me on. I'm looking forward to kind of communicating our economic vision. There are time periods where there's not a big shift to the economic outlook, but of course, right now, having just passed the second quarter of 2022, there's a lot changing in the current environment that I think, does demand our attention. We have these gauges, as the financial industry is great, but, at the same time, sometimes we talk a lot and people don't actually know really what we think. The gauges are there to kind of help communicate our expectations about the stock market. The gauges, our founder is, kind of a yachtsman and really loves boats, and we've gone with a boat throttle theme. So if the gauge is to the right, it kind of means we feel positively about the, condition that drives stock prices. If it's neutral, straight up and down, we feel just that neutral about it. And then if it's to the left, we feel negatively about it. Cool. These gauges help us with clear communication. We're going to make a lot of comments, and equivocate here or there on different sides of issues, but the gauges kind of keep it simple for everybody to kind of understand where and how we feel about things.
Okay. Well, also, there's a lot of questions about the economy and the markets right now, and I think this is a good timely topic for us to go over. Whenever you're ready to start, I noticed that the economy gauge, you can see the way that these read is it shows where it once was and then what you guys are where you see it has transitioned to or is pointing toward. So it looks like the economy's gone from a slow position to a maybe even slower or neutral position there. Would you like to expand on that for us?
Yeah, absolutely. You're right. The economy, we have notched that gauge back. We want to move this kind of to neutral territory, and it's primarily because of the heels of the strong financial results that we saw last year in the economy. Technically, the first quarter of this year was slightly negative. And obviously that has to do with the tightening monetary policy conditions, fancy talk for what the Fed is doing and how much they're making money cost. In the second quarter, we put this gauge back to a neutral position because the Fed is really focused, and I'd add for the first time in a while, to reining in inflation. They've kind of put inflation focus on hold during the pandemic, focused primarily on keeping the economy in the best possible position, keeping jobs in the best possible position. But that unfortunately has led to some price instability, as we know, with high inflation levels. We believe this is going to be a headwind to economic growth. We believe that the second quarter GDP will still likely be positive, but we acknowledge that growth is likely going to be a lot less. Last year, the economy grew between 6 to 7%. That is, too strong of a growth path, from a Fed standpoint. So the reopening, has exposed issues in the labor market and the supply chain and part shortages, hiring issues, as we know from, seeing help wanted signs in the window. And inflation has, of course, become the dominant theme so far this year. When the pandemic hit, the Fed was really focused on the full employment side of their dual mandate. And I think you could argue that they've accomplished that. And unemployment is low. It's at 3.6%. But now we're seeing inflation readings that are uncomfortably high. And that is why we've, kind of notched the gauge back to neutral. The jobs and the economic growth are not the issue that we're seeing today. Today, we are seeing price instability with consistent inflation numbers between 7 to 9% year over year. So that's why we've got the gauge at neutral right now. We do not know, obviously, whether a recession will develop. Right. If there is one, we likely expect it to be a weaker, shorter recession, because a negative 40% GDP contraction like we saw during the pandemic is not something we're seeing in the data currently.
All right. Well, that's good.
Yeah, we do kind of still expect, pretty decent economic growth this year, just a lot less than last year.
Which is, that's a little better story than you hear if you flip on the news these days. Quite a bit of negative talk, and the recession word is thrown around in about every discussion if you watch any financial news. And that picture shows that, what I hear from that is it's kind of a normal stage of an economic cycle. And we're just in that part right now, but it's, not maybe as depressing as it may seem. The next gauge here is the monetary policy, and you touched on that a little bit when you were talking about the economy, but I'm sure we could expand on that as well. Looks like the monetary policy have shifted to the negative side of the dial as well.
Yeah, the market reacting to the reality that the Fed is genuinely on the inflation case earnestly and aggressively is the primary reason, why we've seen a lot of the volatility. Of course, war and politics and corporate profit, guesses are always part of it. But monetary policy shifts have really been the main reason that we've moved this to a half backward position. Several more rate hikes are expected in 22 and 23. Mm-hmm. But the markets, seem to have priced a lot of this in, and interest rates are still low from a historical perspective, which is why we technically have interest rates at a neutral, but monetary policy at a deep, kind of half, reverse position. Okay. The Fed's balance sheet, which was at $4 trillion prior to the pandemic, expanded to $9 trillion. So there's a lot more money in the system. We've seen in the past several years that when the Fed increases its balance sheet, stocks do react favorably. And the same formula kind of played out in March, from 2020, March 2020 through the highs that we saw through the end of last year. Now the Fed, begins their rate hikes and reduction of the balance sheet, and the market is really, not liking, that type of approach from the Fed. Due in part to this change in Fed policy, the market environment is going to be volatile this year. We know one of the primary tools that they use is raising interest rates, which is, what they're planning on doing. They've already hiked a quarter percent, 0.25%, 0.5%, and then a 0.75%, which is really the largest interest rate hike they've done since the 1970s. We do expect them to continue to hike until they reach a level where inflation comes back under control. So that's why we have monetary policy has been the biggest shift in our gauges of late. And it is the primary reason that we're seeing volatility in the markets these days.
Okay. So speaking of markets, the next gauge is valuations. And obviously we've seen stock prices fall. You guys have left that unchanged at neutral. What are you, and from an investment standpoint, market standpoint, could you expand on that a little bit?
Yeah, at the end of the day, investing is about getting value, right? When you're purchasing something, you want to make sure that the price that you're paying, is worthy of the enjoyment, and when you're buying stocks, you're really buying earnings and growth prospects. The price to earnings ratio is just that. It's the price of stocks compared to the earnings of the companies. It was close to its highest level in 20 years, following the pandemic. Now that kind of makes sense when interest rates are lower. It also makes sense when earnings, as they were very strong and growing aggressively, were present. But what we've seen currently is actually earnings that have been growing, although slowing in their pace of growth. They're still growing while prices are down, somewhere between 15 to 23% in the stock market so far this year in 2022. What that's basically, shown up as is price to earnings multiples coming down to what we would consider pretty fair levels. We do not have the valuation gauge in kind of what we would consider stocks expensive territory. Now there's some debate, should the gauge be positive? Should the gauge be neutral? Because interest rates were moving up and set to continue to move up, and obviously things can cost more when interest rates are lower, because rates are moving in the opposite direction, we opted to keep the gauge neutral. But when you look at actual price to earnings multiples, we are trading slightly below the last 30 to 40 years worth of average prices. Generally, you do see that earnings drive stock prices over the long term. Politics and fear and greed and emotion and exuberance and excitement, they clearly have an effect as well over the short term. But what really drives prices over the long term is earnings. Earnings are actually looking pretty decent this year. We've seen earnings expansion in 2022 after a record year last year, and yet we're still seeing the stock market come down. So I think we can say for the first time in a while, stocks are no longer expensive compared to history. And while it's unpleasant to go through those contractions, it is healthy to know that stocks purchased today are trading slightly below their average price over the last 30 to 40 years. The last point I would make on that is that stocks compete with bonds. And when you look at treasuries, stock yields are still in positive territory compared to what you get from treasuries. So we decided to keep this gauge in a neutral position because stocks are not cheap exactly, but their valuations have improved a lot, and they're reasonable given where interest rates are. And I would add, from our perspective as an active manager, we look at valuations on a company by company basis, not just the entire market. And the recent volatility that we've seen has provided us, a lot of opportunities to be in high quality companies at what we feel are pretty compelling prices. And to make real deliberate investments in this environment. So that's kind of what we think about valuations currently. Definitely some positive news there from where we've been last year.
Yeah, anytime you hear that the word opportunity and investing, that's a good thing, and that's what I'm hearing there.
Absolutely.
The next gauge is investor sentiment, and I've been hearing in the news that investor confidence is at all-time lows and that kind of thing. I would assume that plays into probably valuations, but this gauge as well, right here, investor sentiment.
Yeah, it really does. And I actually think the two most, notable gauge changes, that we see here is monetary policy, which we've already covered. But the other one is the one we're talking about now, investor sentiment. Investor sentiment is a contrarian indicator. So What that basically means is when people are in a bad mood, that generally means there's maybe some upside to the market because of the pessimism being the dominant emotion. And the opposite is true. When optimism and euphoria and greed are more dominant, and as humans, we are kind of caught in that cycle sometimes, of course, we're seeing investor sentiment lows that are lower than we've seen in history, or at least the last 50 years or so since the University of Michigan has been measuring it. And what that really translates to is that there's a lot of sellers in the market. When this gauge is to the right on our gauge system, it basically means that there's a lot of pessimism in the market. Another indicator that we look to is kind of the volatility index, or the industry folks call it the VIX. Volatility has been much higher in 2022 compared to 2021, and really, further gives us comfort in putting this gauge as far forward as we have it. The elevated levels of the VIX, don't really reflect higher levels of concern in the market, but we've not, seen a spike in the number. We've not seen a spike in the number this high in a while. It's often these spikes in the VIX that coordinate with market lows. So between the VIX and consumer sentiment being so negative, it does, seem to indicate to us that there's a lot of negativity out there. And the forward returns historically after these really large troughs of confidence, dropping, tend to be, relatively strong compared to, times when people are feeling more excited or, happy and optimistic. So we're definitely watching. This is the most volatile gauge by far of the 5 here. This gauge in the last 2 years, we've had it all the way over to half negative to half positive. And, it's kind of gone full circle. And right now we've got it almost about as positive as we can right now because of the extreme levels of lacking confidence and pessimism in the market today.
Okay. All right. Well, and so the last gauge here, and you've touched on it just a little bit in several different other points, but interest rates remains at neutral as it was before. And you talked about the Fed and how it's interacting with interest rates. Is there anything else you'd like to expand on that?
Yeah, maybe a little bit. I think sometimes humans, we often focus on, things that are very recent. And sometimes we're guilty of forgetting some of the history. And, even if we just go back a little ways, not all the way back to the 50s or 60s, but even just 2 or 3 years ago, the Fed in 2017 and 18 was in the process of tightening and raising rates. 10-year Treasury rates, which are kind of looked at as a bellwether for the bond market, were around 3%. Today, treasuries are similarly around 3%. Now, what we're missing between 2018 and 19 and today is the incredible ride that interest rates and Fed interest rate policy has taken, right? We saw rates in 10-year treasuries, drop down to just over 0.5%. A 2.5% move in treasury rates in that very compressed time period, that's a big move. A big move also is when we come back to the other direction. We've gone from 0.5% of 10-year treasuries to, a spike almost over 3.5%. I think it's important to remember, though, when you look in a 3-year period, we have come full cycle. The Fed is raising rates. The market is anticipating in advance of those rate hikes and pushing rates higher. The reason we don't have interest rates on this gauge at a negative, like we do monetary policy, it's because while rates are quite a bit higher than they have been during the last 2 years, they're not a lot higher than they were 3 or 4 years prior. And I think most folks, especially the ones that can remember, the high inflation and the high interest rate time periods of the 1980s, we really couldn't call today's interest rates high compared to history, just a lot higher than they were a year or two ago, but actually relatively similar to where they were in 2018 and 2019, as the Fed was, kind of, in their tightening mode after the subprime mortgage crisis recovery. So we're neutral on interest rates, neutral on valuations. We've seen a degradation in the economy growing and monetary policy, of course, and that investor sentiment negativity has led us to put that gauge at a very far forward. I've got some kind of closing thoughts I can share with you, but I'll turn it back over to you on the interest rate question.
Okay. Well, all of that is very good information. And I hope I'm not stepping on your toes here, but what I see, or what we talk with our clients quite a bit about, is the market reacts oftentimes in advance of economic moves and that kind of thing, in prediction of or anticipation of certain economic moves. And these gauges, I think, are pretty good ways to look at that, and a good reference for when you're trying to decide what your next investment move may be, or if you need to shift anything around. It's a good place to start. So, and I'd be very interested to hear what your closing kind of summary remarks are on all this.
Yeah, I mean, we know these are challenging times. I mean, this is the worst stock market, 6-month period, first half of the year in the stock market since 1970. The good news is that the U.S. economy is, rebounded strongly from the pandemic. We unlocked some, unknown skills. We're using some of those skills today with this podcast and doing webinars. Earnings are strong. Unemployment is low. We also have to acknowledge that we're coming off of a really strong year in the stock market. Last year was a year where we saw U.S. stocks up, between 20 to 30%. Sure. The Fed policy is really the story this year. They're trying to pull some demand out of the system because of the economic situation with inflation at unsustainable levels. The Fed is determined to bring these things under control. And this means higher interest rates, a reduction in the balance sheet, and just tighter financial conditions. The economy is facing challenges, from the Fed, but we do expect the economy to still be in a growth mode in 2022. At the end of the day, corporate earnings have been relatively strong since the pandemic lows. We're going to need to be mindful of where earnings revisions kind of come in and change the profit, expectations of corporations in the second half of the year. And we also acknowledge that there could be some volatility from an economic and stock market perspective, but ultimately the fundamentals of the economy are pretty solid. And we just urge clients to kind of stick to their financial plans, not make huge emotional decisions based on short-term, numbers from inflation in the economy or political movements in the country. So, have a plan, stick to the plan, make good decisions, own good companies at reasonable prices with improving business momentum, and, just recognize that this is a very, very long journey being a stock market investor. So I hope that's helpful. I appreciate the questions.
Yes, and I appreciate your time. Once again, this is Michael Cole. He's a senior investment consultant with Clark Capital Management. We've worked with Clark for several years, and they've done a great job for us and our clients, and appreciate not only your time today, but the time that you've helped us serve our client base and help us make sense of some of this stuff through the years. And
absolutely, it's our pleasure.
Well, we appreciate you joining us today for the SRP podcast, and look forward to the next episode. Once again, you can learn more about us at seretirementplanners.com and see previous episodes of our podcast. Thank you for joining us, and have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.